of this module is to explain when employee elective deferral contributions are considered timely under the law and what to do if they are not. The Department of Labor requires that elective deferrals must be remitted on the earliest date that the employer can reasonably segregate the amount from the employer's general assets. However, in no event can the deposit be later than the 15th business day of the following month. In an audit or in the event of an audit, the DOL will determine the earliest time deferrals are deposited for a particular plan and sets that as the deadline for deposits ongoing. The DOL does provide a 7 business day safe harbor for small plans that are fewer than 100 participants the first day of any particular planning year. Failure to timely deposit employee deferrals may constitute both an operational failure, failure to follow the terms of the plan document, and a prohibited transaction, which is a transaction between a plan and a disqualified person. In order for the employer to obtain a tax deduction for their employer match, the match must be contributed to the plan at the time the elective deferral contribution or later, but not later than the filing deadline for employer income tax returns, including any extensions. Any other types of employer contributions, such as non-matching contributions to the plan, must be made by the filing date of the employer's tax return, again, including extensions. So the action steps is review your plan document for the timing and the amount of your matching and other employer contributions. Finding mistakes. Well, simple. First, determine the earliest date that you have or can segregate deferrals from your general assets and compare that date with the actual deposit dates that have been made. Also consider any plan document. Note that although it isn't common, some plans do contain specific provisions for deferral timing. Fixing the mistake. This failure is usually corrected through the Department of Labor's Voluntary Correction Program, or the VFCP. Note that if the plan document contains language regarding the timing of the deferrals, as failure to follow the plan document may need to be corrected then by the IRS Employee Plan Specific Requirements Compliance Resolution System, which is a corollary to the Department of Labor's VFCP. It's the EPCRS. Generally, correction for late deposits requires a plan sponsor to determine which deposits were late and calculate lost earnings necessary to make the correction and then deposit the missed election deferrals along with the lost earnings into the trust. And excise tax may also be required to be paid on a Form 5330 or 5330. So action steps: establish a procedure that requires elective deferrals to be deposited appropriately. Determine who is responsible for ensuring timely transmittal and create a redundancy for unseen circumstances. Coordinate with the payroll provider and others who provide the plan to determine the earliest possible reasonable time to make the timely deposit. Implement practices and procedures to ensure that incoming personnel have a full understanding of when deposits must be made.